biggest ticket we raised for debt in terms of money from one single individual was 2 million. When these fucking motherfuckers, these young entrepreneurs that read books about Elon Musk, when they come to you with a fucking presentation, they say, give me like 200K. And then you ask them, okay, are you ready to put your balls on the line and like give some collateral, like promise something or something? They're like, oh, come on, this is not how business is done nowadays. Like, we're offended, you know, because you're asking somebody to actually risk something. Somebody that wants to build a fintech company or provide some kind of financial service, they couldn't care less if JP Morgan is rolling out blockchain, you know, trading. It doesn't affect like regular people. Actually, you can never really know whether the market you've picked is going to be any good or not. Currency dropped by 60% and we just lost a couple of million in one day. 95% of the companies in the world are following somebody else. What up, bro?
What up? How much money have you raised for your fintech businesses?
Too much to count. So let's separate the debt and equity, because equity is, I think, harder to raise. Debt is the easier, it's more available. Equity, so around 30 million. Debt altogether, I haven't counted because I have several companies. We have raised money, we repaid it, then we raised again, and so on. So I would say certainly over 200 million for sure, which might be a big number, but it's all relative. It's nothing if you look at some classic credit related companies that I don't know, provide funding for real estate. Yes, it could be 200 million for one deal, but we're talking specifically consumer loans, small tickets. So in there, 200 million is much more than in some kind of like a B2B type of lending business. So that's the rough number.
What is your framework or blueprint for raising money?
Man, all right, good question. So I would try to make it short by talking about how it was in the beginning and how people raise money when they don't have a lot of experience, where they don't have connections and an understanding of how it's done. And the usual, you know, route is you go to people that you know, maybe some people that, you know, have some money, relatives, friends, connections. I would usually say your immediate network and the second level network, people that through which you know somebody else, right? So that's one. And second is you would normally raise small tickets, a couple $100,000, and not from one person, but from a number of people. Yes. So let's say there's a standard investment agreement, and based on that agreement, you want to raise 200,000, and you say minimum ticket is as little as 5,000, right? And it could be that not one person gives you 200K, but it's like 10 people give you on average 20K. So that would be a way to raise startup seed funding. I think nowadays everybody is fairly informed about how to do it, because there's a lot of information. There's a ton of, you know, startups that get funded, so that's not super unique. So that's back in the day in terms of equity. In terms of debt, back in the day, how we did it, we went to rich people that have, you know, high net worth individuals. Now they're called angel investors, right? They used to be just called rich fucking guys, rich Russians mostly, you know, rich Russians. So my first both equity investors and debt investors, they were all people that I knew from university, having studied together with those guys, and they come from rich families, one from Azerbaijan, one from Kazakhstan, one from like number of people from Russia. And that was just, you know, a way to go to raise money from East back in 2010, 11. And so in terms of debt, we would just agree on a contract. Somebody would give you a 500K, 200,000, sometimes $1 million. The biggest ticket we raised for debt in terms of, you know, money from one single individual was 2 million debt. And we paid 24% per year, 2% a month on that debt, plus a personal guarantee. And that wasn't the highest interest we've paid. We've paid 48% per year interest. We paid 36% with guarantees, personal guarantees, sometimes collateralizing parts of our company. And so when these fucking motherfuckers, these young entrepreneurs that read TechCrunch and read books about Elon Musk, when they come to you with a fucking presentation, they say, give me like 200K. And then you ask them, okay, are you ready to put your balls on the line and like give some collateral, like promise something or something? They're like, oh, come on, this is not how business is done nowadays. Like, we're offended, you know, because you're asking somebody to actually risk something. So the good old mentality back 10 years ago was when we actually risked a lot of stuff, you know, when we raised money. But that was back in the day. Nowadays, we have a more institutionalized, more kind of like systematic process to raise funding, because when the company gets bigger, first of all, you as a founder don't necessarily need to raise the funding. You can have a team that is investor relations, a CFO, CEO that are experienced in presenting the company. They know the details of the business. They know the financials. They understand different finance instruments like bonds, equity instruments, convertibles, different types of things that you can use to fund the business. And they do it basically independently. And so you as a founder, you can kind of step back. In some way, some of my companies are doing that independently. Another big thing, last big thing I would answer is crowdfunding. So for companies like ours, we usually are seen by banks, by kind of traditional funding providers as competitors, yes, and as something that's unfriendly, yes, and so it's very hard to raise money from classic kind of banks. And so crowdfunding has emerged as a very good tool because you raise money from a large number of people, small tickets. It's very flexible. You pay high interest, but you can kind of like use it as a tap when you need it. You open it up. When you don't need it, you close it down. And so in my industry, in consumer lending, crowdfunding has been a great tool. And also what's important, you can build your own crowdfunding, either campaign or even a website and a platform if you have enough supply to give to these investors. And therefore you can have your own platform. And that's when you control your own destiny when it comes to fundraising, and which we have done a couple of years ago. We built our own crowdfunding platform. So that has been a big change compared to like 10 years ago.
I think many people, when they think about raising money, they're like always trying to protect the equity.
Yeah.
What are some of your ideas or tactics or strategies to get the most money for the least amount of equity?
Yeah. You remember in a conference, I mentioned one of the big mistakes was that I was giving away a lot of equity. Yeah. So I hope I've learned, but what are the ways to do it? So the best way to not give up equity is to have alternatives. That's very simple, right? If you have one guy or one person or one VC or angel investor that is ready to give you 200K, but he wants 20%, right? That's huge for that amount of money. It's justified because the risk is massive, but like, half a year later, the risk is much smaller and you've given up 1/5 of the company. So that's not cool. Okay. How to get rid of that is to have more than one person to potentially give you money. That's like the moment you have more than one person, your confidence and belief that you can get money increases dramatically. And with that belief and that emotional state, you become a better negotiator because you don't give a shit that much about this one person who might give you money. If they don't, they can fuck off and we move on. And that energy is very useful in negotiation, right? And I'm using kind of maybe aggressive terms, but generally to have alternatives, that's one. And it's a luxury to have many investors or several investors to be willing to invest. We oftentimes didn't have that luxury, or we thought we didn't have. Anyway, that's one. Second is just don't accept a deal that you're not ready to take or you think is in the long term not good for you, at the expense of understanding that either that's going to put you in really major kind of like cash flow difficulty, or things will take much longer than if you would take the money now and just grow faster but give up too much equity. So that's second. Have the ability to just say no, walk away with no alternative, but having faith that something better will come. That's it's more an emotional kind of a position to take. That's second. Other ways. Third one for sure that we did, which is I think a cool formula, is when you are building out your business, maybe you go into different product lines or in different countries, you might not necessarily want to raise one big amount of money and give up a lot of equity for your main business, but you might go into a separate country, into a separate market, or open up a new product as a separate entity, raise money for that separate entity, yes? Give up, let's say, 35%, which is too much to give up in your main company for, let's say, a couple 100,000 or for $1 million, and then repeat that several times across maybe different entities, yes? In our case, we did that across different countries. We would enter different countries very quickly. In every single country, there was a separate investor that would give money for that country alone, and equity was given at that country level alone. And then once we became bigger, we were able to then consolidate and say, okay, you have 40% of our Polish business. Let us give you 5% of our holding company and then do an equity swap, right? So the person in Poland would get shares in the holding, but already from a position where we were much stronger negotiator, right? So that's another tool. And then the fourth one I would say is try to take debt instead of equity. Early stages where you don't give up shares, but you can maybe pay interest or pay interest later, but just avoid literally giving shares right now, but you still get the money into the account, because in the early stages especially, debt and equity is kind of the same thing. There is nothing that supports that debt, right? So for the investor that gives the money, it's actually they're taking the same risk, so you're better off kind of taking debt, but the investor is risking as if it was an equity investor. So, yeah.
Okay. So we were actually asking our colleague, who's the research person, to come up with cool topics, cool questions to talk about with you. And here are
about
some
fintech kind of scaling.
Yeah,
fintech
about
businesses.
fintech businesses scaling. So the questions came up were blockchain technology, cryptocurrency platforms, neo banking, Apple Pay, Google Pay. But we actually discussed about it. So what is kind of the reality of scaling and growing a fintech company?
Yeah. I would add my 2 cents before we go through this list, is that especially like I've participated in conferences, in some interviews, podcasts, and so on. And generally, when people talk about fintech, they always give these bullshit questions, these bullshit topics. What do I think about blockchain? Are neobanks or fintechs competing with the banks, or are they collaborating? And the answer is like nobody gives a shit. Like a regular person or somebody that wants to build a fintech company or provide some kind of financial service, they couldn't care less if JP Morgan is rolling out blockchain, trading, right? It doesn't affect like regular people. So with that, what's more important, and we can go through the list and have a laugh about the points, but I think much more important, specifically in fintech, specifically in financial services are mostly regulated. The one thing that every fucking fintech entrepreneur always thinks about is how to bypass, work around the regulation. And not in a negative way, but in a way that you can sell your products more aggressively, or if you can operate without a license, because the license to sell your services would mean that you have much bigger cost, or that you can do a very limited set of things. And so one of the big topics specifically in fintech and other heavily regulated industries is how do you operate in the gray zone while still being legit, right? And getting big enough, profitable and valuable enough, where you then can go for a license, and then you can become fully regulated, because then you can afford it, yes, and then you are protected. But in the beginning, how do you operate without a license? How do you sell your services without incurring all these extra costs? That is the real question, I think, specifically for fintech.
And how has do you know some specific examples from Revolut or Wise?
I think every especially all the new age fintech businesses, I don't mean old banks, etc., have started with the fact that they are doing like regulatory arbitrage. There's this cool terminology, regulatory arbitrage, which basically means like I start my service, it's not defined and specifically regulated at the moment, and then it becomes popular and it becomes big, and then the government starts regulating it. It says you need then a license and all these different things, and then I acquired the license. And so Revolut and companies like ours providing consumer loans, all of those businesses have been able to grow quickly in the beginning because they were not regulated. Also crypto, the same thing with crypto, right? When you started crypto exchanges, there was no regulatory framework. Now there's MiCA, there's different regulations that require you to have a license before you can sell digital securities and so on. And so any single example that we could look at that is a fintech that's not older than 10, 15 years has started and has become successful because when they started, they either figured out how to bypass regulation that applies to them, or there was no existing regulation. And once they became more popular, they became profitable. That's when the regulation came, but they were so big that they could then afford to be regulated. Yeah?
Isn't it so that when you're talking about this, the only thing that comes to mind is look at emerging markets where there's not so much competition, or the market is so new to these financial services that you could do that there?
Yes, I guess that's a standard trend that applies to, I guess, any growing market that's getting more and more regulated, and the tobacco is probably the same thing, and many other industries. But for example, in our case, in consumer lending, when we started back in 2010 and 12, basically you could just set up an entity, LLC, a minimum paid capital, and start rolling out loans to consumers like it was nothing, like no license, no requirement for paid up capital, no restrictions on marketing.
Baltics, right?
And we started in Latvia. Then we went into Czech, Poland, Slovakia, all these different countries. If you look at fast forward, if you look at it now in Europe, there are maybe some exceptions, some countries where you can do it without license, but generally everywhere you have a heavy license that's regulated by the central bank, a lot of restrictions. It takes at least 6 to 12 to 18 months to get the license. And yes, a way around it or to keep growing is to go into less regulated, more emerging markets. That's a standard. But to be honest, in the fintech sector, in the last 5 years, all of the big hot markets, emerging markets like Latin America, some of the Southeast Asian countries, big African countries, Nigeria, Kenya, etc., they all are heavily regulated as well. So it's not like they're falling behind Europe or America like heavily. Maybe in some consumer behavior, it's still a little bit lagging. But in terms of regulation, I would say, as far as I see in the lending part of fintech, it's all globally very regulated.
But from your experience going from Baltics to East Europe and then going to the African market, how have you identified potential opportunities, or what is the thinking process to identify something where other people are watching this? They're thinking, okay, I have a fintech idea. It's not in lending. It's a different topic. How would you recommend them to identify markets?
No, that's a good question. And I would sometimes laugh and say that there's an answer that you give to a VC, and then there's the real answer. The answer that you give to a VC is you say you've researched, you've done your Google desk research, you've spoken to people, you've looked at all sorts of macroeconomic reports, you've gathered, indexed different countries, you've looked at, SWOT analysis, competition, red ocean, blue ocean, you've mapped out all these different competitors and whether they have the product you want to offer or not. And then figure out, okay, where's the biggest purchasing power of a consumer? What's the penetration of internet banking and things like that, right?
That's the official answer.
That's the official answer. And of course, there is some sense to it, and you should apply some logic when you look at new markets. But the reality is, in my experience, you kind of never really know whether the market you've picked is going to be any good or not. Our success rate in picking different countries, I've opened businesses in at least, I think, 15 different countries. Yes, for sure, like 12 or 13, but I think it's up to 15, including New Zealand, which was the dumbest idea ever. We had the idea to open a business in New Zealand, which seemed to be the most remote from Latvia. To prove the idea, which I had this fucking stupid idea, is called a remote business or something, which basically said, if I can prove that I can work in New Zealand successfully, that proves I can work anywhere successfully. But we didn't succeed in New Zealand. But anyway, that's a different story. So the question was about picking the country. So the real answer is you never know. That's why you don't, in my view, you don't optimize for the research and try to optimize and figure out what's the best way to finding the right market. What you optimize for is what's the cheapest and fastest way to test a market, because there's nothing better than actually going in, testing out at the cheapest possible cost and the shortest time. And only actual test of the market will tell you, can you sell your service there? Is there demand? What about competition? You maybe imagine that, the legal system works the way you expect it to, but actually it's completely different. Maybe you figure out that the people in that country that you pick have so little knowledge about your industry and your business model that you have to literally hire people and educate them completely from scratch, which is a real nightmare, right? So there's all these different things that you could never even imagine are there, and that they will make your business more difficult or easier. And let alone about currency risks, right? You can maybe be successful, make a lot of money, but you haven't pulled it out from the country, and the currency drops because it's in an emerging market, and you've lost everything you've put in. So we had that, for example, in Sri Lanka. Currency dropped by 60%, and we just lost a couple of million on one day, right? So the point is, optimize for quick tests and experiments, and how to optimize that is follow bigger competitors. Especially if you're not a trendsetter, you're following other companies. 95% of the companies in the world are following somebody else, right? There's very few pioneers and trendsetters. So follow an existing company, If some capable big business is already doing what you want to do in a new country, that means they've done all the hard research, the hard work, and cutting through the mud. Follow them, copy their processes, ideally hire somebody from their team, and then you've already done half the work, and then the other half is just to try to roll out your product, and then see in a couple of months, having spent like, I don't know, 100,000 or 50,000, if the feedback is there. Can you get customers? Can you convert them to sales? If it involves some kind of like, I don't know, logistics, sending something out, do the logistical infrastructure and framework works. In our case, it's signing distance contracts, right? It's important that we can have a consumer sign a contract with us online, as opposed to having a physical signature, right? So can that happen? Does that work? If not, are there some workable solutions? And that you can only figure out by testing. And so optimize, again, like I said, cost and speed in testing that out. And the more you can test out, the faster you will understand the reality about different markets.
Have there been any markets where you test and you have the result and you're like, this is not going to work? And what were the benchmarks or the numbers where you made that decision? Or what are the kind of...
Slovakia was one of those. There was a whole other set of problems there, but Slovakia was very complicated. Let me think. Other markets. New Zealand, we had a management problem and a communication because it was far away and so on. But Slovakia, it was difficult to get clients, to buy customers so that they come to the website and they convert into actual sales for whatever reason. They didn't understand the product. They didn't trust like somebody giving money online. They thought it's maybe a scam, all these sorts of different reasons. It was also hard to find people there. And we had a bad setup whereby we were managing and launching the Slovakia office from our Prague office from Czech Republic. So that was inherently a flawed kind of setup. So we killed that, I think, after a year of being in a business.
When you're saying testing the market, does that mean, hey, setting up a website, buying some ads, running to the website, seeing how much they convert?
Yes, I would say everything until you actually convert a customer who pays you money. In our case, we also need to get the money back. So the testing is all the way until you get the money back. In case of when you, I don't know, somebody pays you for a service, you need to send them a box of shoes or, I don't know, whatever other service. Your test ends where the customer sends you money and you deliver the product or the service. And doing that full chain is what I mean by testing.
The full chain.
Yes,
how
full
many
chain.
customers
not
are looking?
only like registering a website, opening a website, and driving some buying some ads to get some traffic. I mean, that can give you maybe some top funnel conversion rates, but not much more.
How many customers are looking to get to kind of validate?
To be honest, I'd say like when we get to a point where we are committed already to go into a country, we probably have gathered so much information and that we are very serious about opening up. Lately, we haven't opened up markets where we are literally just, even though Jordan maybe was a bit of a different case, we opened up, we got the country manager, established the company, and we did not have kind of any expectations because there was so little known about the country. And there was not a lot of competition. And in the first month, I think, we already saw that there's a demand, that this business model can be successful in terms of count. I think it was more like general KPIs that we saw. Like on average, a consumer takes a big ticket loan, which is very good, right? Instead of taking like a $5 loan, they take a $500 loan. So a big average ticket is good in any business. Big average ticket is good. That was one. Second, there was demand. So people came to us. It wasn't like we had to work for 2 months to figure out how to get the first customer into the door. We opened a branch. They came in. It was like, it was active and in demand from the very much day one. And so those factors are enough to kind of understand. And it's not something that you can quantify in like thousands or hundreds. It was like a general feeling.
Cool. What's the story about New Zealand?
And so in New Zealand, like I said, the idea was that we want to build a global company and let's stick a flag in the map somewhere in a country that is so far away. And if we're successful in that country, that means we can just literally globally operate this business globally. And that was the story with which we went to VCs. that was one of the angles of the overall story, right? And what happened is we agreed with one of my actually school mates who had gone to New Zealand for some work, project. And I had known him from school, and we just kept in touch. And he said, "Yeah, like it looks like some lending is also happening here." We looked at Australia. Australia is a big market for consumer lending, very regulated, very developed. And we thought, okay, so New Zealand maybe is like a trap door, like an entry door into the bigger market, which is Australia. If we can figure out in New Zealand, lower cost, easier, then we have this big, bigger catch. That was a side topic. And then what happened is just the country manager didn't manage to build out the operations for different reasons. We didn't maybe prioritize enough, and it was, how many hours time difference? So it was hard generally to manage, and we had a lot of other things going on. And so at one point, this New Zealand idea was just it was just like a unborn child, like some dead child somewhere on the operation floor, and we just dropped it there. So we just closed it down.
What's kind of the difference between many people look at this information, which we are going to put out in the internet about raising fintech capital or debt? Many people look at USA because the most content is from USA. What's kind of the difference between USA raising money and here in Eastern Europe raising money?
Yeah, I think, that's a completely different world. First of all, in my simple assessment, everything you do in Europe, not even Eastern Europe, versus the US is just 10 times more, 10 times higher costs, 10 times higher valuations, 10 times bigger funding rounds for the same effort.
For the same effort?
For the same effort, of course. It's not like people in the US are 10 times smarter or harder working. It's not like that. We live in a global world. But everything that goes into the US is just 10x. Just by the fact that it's such a massive market. It's a huge market, right? Any legal opinion just is more expensive because it would apply to different states, right? If you want to figure out something that applies across states, it's just straight away more expensive. It's like saying, okay, you want to start business in Latvia versus if you want to figure out how to do that same business across Europe, right? And that's the idea in America. You don't go in just this one place. You go into the whole market. All the prices are more expensive. Salaries are higher. Competition is bigger, and the market size and the upside is much bigger. So that's why I'm saying it's 10x. And that relates specifically to fundraising, distinctly, because obviously fundraising culture in the US is far more developed one, but it's just more vision-based. It's more aggressive. It's more risk-taking than compared to Europe. So, for example, this is a very common experience with most founders. For a startup to raise money, if you go to Silicon Valley, you can have an idea and some maybe inception of the idea, some minimum viable basic product, and you can raise a couple of million fairly easily, probably in a couple of weeks, in a month or 2 months, if you're actively doing that and you've built infrastructure, versus if you try to do that same thing with that level of readiness in Europe, let alone in Eastern Europe. Investors will say, come back when you have a real business. Come back when you have like a proven revenue. And when you have proven revenue, then they will say, okay, come back when you have like profitability. When you have profitability, you're no longer a VC business. You're like an established company. Like, how is that a venture capital? That's already established. So anyway, much easier to raise money in the US when it comes to an early stage, higher risk funding compared to Europe, and that's why a lot of founders go and try to do that there.
Right. Do you have like a framework of how to structure the pitch so you can get the most amount of yes or the least amount of effort to get a yes?
I will start by saying I'm not an expert in how to say structuring pitches. I think there are, especially nowadays, like 10, 15 years ago when we started doing this, it seemed like it's some kind of a unique knowledge. You have special knowledge if you understand how to put together an investment deck, present it, and so on. Nowadays, I think like the information is so much out there, so much available. So people that are doing this actively and preparing pitches, they're so well equipped compared to, let's say, somebody doing that 10, 15 years ago. Nevertheless, a pitch, so I probably won't say anything new. So the pitch needs to, first of all, distinguish between equity and debt. That's one thing I've learned when I was raising money. Oftentimes I would be raising money in terms of debt, or wanting to raise debt, and I was always focused on the story, like that we're building out, we're growing, we have enthusiasm, we have a vision. While for debt, it's not really important. What the debt holder, the debt investor wants is to have security over his investment, right? So you have to talk about collateral, about your audited statements and things like that. So I figured that there's a difference of the type of audience that you're addressing. And a lot of the time I've been addressing the debt investor audience, right? And that's much more about your operational excellence, your profitability, your financial statements, availability of collateral, things like that, right? That the investor can trust what you're telling them, as opposed to how much money you're making or how fast you're growing. So that's on the debt side. And so therefore, when you're looking for debt, you should focus on giving sense of security, not talking about a great vision and you're going to grow like crazy. That's one set of things, and saying I have like audited standards, I have a very strong financial controller or CFO, all of my ducks are in a row, all of the house is in order, right? That's when you will get best results when it comes to debt. When it comes to equity, obviously stating very clearly and very succinctly what the problem is that you're solving. Oftentimes that's not very clear. That's one. Second, what is your solution, or how you're solving this specific problem? Third, and that can be mixed up, but why are you the optimal team or person or founder to solve this particular problem? Let's say you're, I don't know, passion, you've been in this industry for long, or you have some connections from the industry, whatever. And then the ask, okay, like how much money you want to raise, to do this, and how you're going to use it, and that's it. And a good pitch, I mean, you can see all these different high quality pitches. They don't need to be complicated. They can be simple. They don't need to be fantastic and great when it comes to design. It's nice that it is cool, but it's not critical. But the best ones that are simple to flick through in kind of like 10 slides, and you have a clear understanding of what is the business and what is it trying to solve, what is the problem that it's trying to solve, who are the people, and how much money you're asking. And that's the first step in the conversation. If you manage to get that right, that's already a big step.
Would you agree that the person giving you money needs to kind of like you, like a person?
Yeah, I guess, I mean, yes, for sure. Like when I've been selling my company, by that I mean like raising money, presenting the business, and so on, it's very important that I am likable and that I can get trust. I think liking, yes, but probably even more importantly is trust, to get so that the investor can feel like they can trust you.
And the height also is important. And the height also.
The height always
the
works,
higher
right?
you are, the bigger you are, or the taller you are, the more trust you have.
Well, man, I mean,
there's
that's already
statistics,
of course. Better looking people have just
way
easier
more,
lives.
Yeah, way easier. Yeah.
Generally, so yeah, all of that works. Nevertheless, I think the trust is the one thing that you want to establish. Liking, yes, for sure. I always try to be likable when I'm trying to get something out of somebody, right? But I think more importantly than the connection, the kind of the liking element is to be authentic when you're presenting, and because pretending and to try to be someone you're not just takes so much energy.
I have never raised money, but what my question is, and what I'm thinking about, what happens? So you have a presentation, you talk to investors, they say yes. But what realistically happens? Do they just like, boom, next day you have
no? Okay,
bank
so
account?
the process is usually as follows, and that's probably regardless of whether it's debt or equity. Let's say you have the option to actually pitch to an investor, whether that's a physical meeting, online. I mean, I've done like all of those types. You present your story. You tell them how much money you need for what you need it for. And then if they like it, they will probably follow up with the question of, okay, let's exchange NDAs, non-disclosure agreements, so that me as a company can provide data about my business to the investor so that they can get acquainted with the business in more detail. So the first is exchange of NDAs, which in itself sometimes is a pain in the ass. Whose NDA are we going to send out? Somebody wants to carve out some points. Anyway, you want to quickly, right after the call, if they show interest, if the investor shows interest, you send them the NDA, send them your NDA. Sometimes they shoot over theirs. You sign them, exchange, done. Second most important step is to be prepared after your pitch. They're going to do what? They're going to ask for your data about the company, right? The presentation materials, overview of the market, financials if you have any, analysis of your products, whatever, description of your technology, high level. If you then start scrambling and thinking, okay, how do I prepare this for you? Let me send this to you over in 2 weeks, and you start sending them some, large documents over email. That's a disaster. So you have to have what's called a virtual data room ready, where all of this is succinctly prepared, folder by folder, with a menu, a guiding menu that has a document that says, okay, if you want financial documents, this is the folder you go to. If you want description of the team and the bios, this is where you go to. If you want our legal contract drafts, this is where you go to. Any administrative documents about our company, like share certificates, articles of association, any of the legal background, this is the reference where you go to. And you have this data room prepared, ready to go. And then the investor is going to ask you, okay, so we signed the NDA, shoot me over some information about the company. And you send the link to this virtual data room, like a shared drive.
Like a Google Drive.
Yeah, like a Google Drive.
That works fine, right?
Yeah, Google Drive works fine, yeah. There are more specific services for VDRs, but yeah.
Okay, and is it very important that it's live? The data is fed from actual numbers all the time, updated?
Yes, I guess, yeah. If you put something that is 3 months old, it's not a good sign. It should be as updated as possible. And what I also learned, this is where we were actually trying to onboard a bank from, can I say this? Yeah, from Philippines. I'm not going to mention a specific one. Very professional guys. We were trying to get them debt, and we were the investor.
You were in the
Yeah. We were looking for options to give them debt, and they were very professional. They had raised a lot of VC funding, so they had this VDR and this data room. Yes, this virtual data room. That's what I'm saying. Okay. VDR. What was cool is not only did they have all the documents, all the presentations, also descriptions about their processes, anything that you would want to, and in a very organized manner. They also had videos of executives talking about stuff about their company, right? Basically, kind of like commentary, department by department, by the head of that specific department. And so the beauty was, which we only learned after seeing that and being in fundraising for 10 years, is you don't therefore need to organize individual follow-up meetings with your teams to explain stuff. You basically invest in, let's say, cameras, people explaining about their product, these executives talking about all these detailed things. You invest time, you put it all together, you make it available for the investor, and any new conversation, any new due diligence, that's the whole process is called due diligence, right? Where you want to give this information to a new investor, you don't have to, again, set up calls, okay, like our CEO can make it this week, not next week. Can we get our VP of product on the call, etc. You don't need to do any of that. There's a centralized data repository where any new investor that wants to understand about the company, they can just connect. And that's actually a very nice way to streamline the whole process. And so when the due diligence starts going, sometimes the investor gives you what's called the data request. So they want to see specific types of things, right? That will be a document saying, I want to see your pricing description. I want to see your, a high-level architecture description of your IT system, things like that. But oftentimes you just, provide documents. And then after that, you will have some sets of questions from the investor, and then probably there will be a follow-up on-site meeting if the investor is interested. And in that on-site meeting, they might, just maybe drill on something or strategy or whatever. If that is successful, normally the investor should give you a term sheet with the proposed terms of a potential deal right after.
Is it typically always worse than you proposed?
Yes.
Right?
It's yeah.
And then you start negotiating.
I don't remember a time where
you're probably always ending up a little bit more than you expected, right?
Yeah. But sometimes, I think it's always worse. I don't remember a case where somebody gave me something better.
You say you want $1 million for 5%. They say, I'm going to give you $1 million for 20%. And then you end up in 10%.
Yeah, but then obviously the whole point is when you go in, I like this phrase, you want to ask the investor something that is your grounded aspiration. That's the terminology in negotiation. Grounded aspiration, meaning you want to ask something that is like a very good outcome, but it's not completely ridiculous. You're not asking for a startup, funding like 10 million for 100 million pre-money, but you're asking for 1 million and giving up like 5%, and it's fantastic. It is grounded in some reasonable assumptions about your company, your readiness, your financials. That's why it's called grounded aspiration, and that is your ask, right? And clearly always the investor is going to say no. Here's a different offer.
For Amazon, it was like 20% for the first million before they had anything to sell.
Amazing.
Imagine those guys.
Yeah, for sure. I mean, they are probably
and they were multiple investors, not just one. Like
I mean, our first investor, Vogar, he gave us 28,000 euros. It was 20,000 lati. Yeah.
Oh.
30,000 euros for 45% of the company.
How much he has made?
Man. But the thing is, what we corrected that major mistake by doing what I mentioned before. Latvia was the first deal. Then we opened other countries. He didn't follow investing in those other countries. And then we consolidated his stake into our holding company. In the holding company, he got a couple of percent. I don't remember. But it was no longer obviously 45%. It was a couple of percent in the holding. And he has made, I don't want to count his money, but like maybe close to 1 million, or for sure like hundreds of thousands on that 30K investment.
Wow, good for him.
Yeah. No, but he's a great guy.
And I like how you're like fine about it. I could imagine some people are like, oh my God, this guy helped me actually to start my business, but...
No, man, I think you can't go in with the mindset of like scarcity mindset, as it's called, this super fucking smart phrase. You have to go with the abundance mindset. But it's not even about... But this is very different for different people. I personally, my approach has always been to focus on making more money rather than spending less and just thinking about where I can save costs. I'm not naturally good at saving costs and being cost efficient. It's completely not I don't have a Jewish mindset. I'm the opposite of a Jewish mindset. Yeah, I'm always thinking, how can we just simply like make more money, grow faster, so we don't care about don't care about costs, but so we can afford stuff, right? So we can afford better, smarter, bigger. Yes. That's always been my approach. But there are people that are, way better than me at fundraising and building businesses that are more focused on being lean, being very cost efficient. And so there's all these different ways. And being cost efficient, always thinking about how to spend less, is a scarcity mindset in some way. Yes. But man, it's like, everybody has their own formula, so it works.
I also went to an astrologist who said the same thing. You just need to look at yourself and just, it's going to be easier for you doing that route. Maybe for you, that's the route.
Yes.
For some people, it's a different route.
And so, man, I think I mentioned also in your conference, the main mistakes I've done have been from not being greedy enough, not being, insistent enough when it comes to equity negotiation. Because my primary goal wasn't to be as rich as possible or make as much money as possible. But my primary goal was always to grow the company as big as possible. That was always the primary goal. So I was ready to give up equity too much, too fast, do shitty deals, all for the sake of let's just grow faster now. Yeah. And I've obviously learned that not always that's the optimal, but that was the goal I was optimizing for. So based on that goal, I was doing the right thing. I was taking like shittier deals where I could have walked away, waited, negotiated more heavily, all of these things. There are so many examples, embarrassing ones, that I've given up equity too fast for too little money, not good enough terms, whatever.
And I think the worst thing that happened by you focusing on the company and growing the company can happen something like that happened to the Steve Jobs, where he gave up the equity and they just ruled him out.
Yeah, but that's a different story. He was a very intolerable person to deal with. That's a different story. That's it's not unique completely, but it's but for sure the point happen, is, but like, let's say the way I can relate it to my experience, which I've talked about also, is we grew the business fairly large. We had 12 different shareholders. We had 5 board members. That was me, my co-founder Davis, our VC. Representative of the family office, and Capitec, I think 1 or 2 seats, the strategic investor, the public bank. And at one point you kind of realize, okay, so all of these guys, they have their own agendas. They want something different out of the company. Like the fact that you're a founder, nobody gives a shit. That's like, I can guarantee you.
How many shares you have?
And what's your voting power? And so, yes, I've been in a position where you've built all this business, you live and die with it for 10 years straight, but then you've created something that's much bigger than you. and you're no longer like the key person. You're no longer the one that can affect everything. Of course, you can have an influence and affect everything, but then you understand, okay, so there's so many vested interests in the business. They can be bigger than you. They can be more powerful. They can push you aside. That's
Is it a
kind of
nice
interesting.
feeling, or is it like, oh shit,
Both.
I lost my baby, basically?
Yeah, it's both. It's the moment you understand that you don't have like a strong control over the business, and by a strong control is basically that you can do what you want when you want, right? If I want to pay out dividends, next month, I can do that. If you don't have that control, you don't have strong control over the business, and we've for sure lost this strong control over the business because we diluted, we had to give up equity, and so on. It's a nice feeling that you at one point, I mean, you realize that this business has completely outgrown your abilities, yourself. It's an independent organism, right? It's an entity on its own. It has its own interest. It has its own budget. It's beyond you. You can disappear, and that entity will continue evolving. And when you feel that, and you see that entity is like a lot of smart people, and they're like doing all these presentations, flying around, investing millions, and doing all this stuff, it's completely already independent of you. That's a cool feeling. But if you've lost control along the way, then that entity is independent.
It's interesting because I'm aspiring to have that. Like it's my aspiration to have an entity like that.
I like what this what's this guy Jim Carrey, the super famous actor. I love him. He's very spiritual. He has a lot of very deep thoughts, and one of them, which I really like, is he says that I wish everybody had the experience of being extremely wealthy and extremely famous to understand that there's nothing much there, or nothing much there, but that's not your kind of like key to all your ultimate kind of happiness. And so I would also wish that any founder, any business person that is really keen and interested in building companies and all that experiences some of these highs, yes, of being in a big business, having built something that grows very fast beyond your control or understanding. It's like cool. It's amazing, right? But the moment you're gonna go through it once, it's okay. It's an experience. And then you just need to move on to something else, and it is no longer as ever next time as exciting, right? And then you start more focusing on, okay, like actually this means that I didn't get the satisfaction there, and so it becomes like you start treating it, slightly differently.
You're never satisfied, right?
Yeah. I mean, you're never satisfied. That's the thing you need to try to focus on: being satisfied with what you have rather than just trying to get more.
I think when we do enduro, I'm also like, after the training, I'm tired, but I'm never satisfied because it's like, I could have done better.
Yeah,
But
it's I just spoke with a lady, one of the people that I speak constantly about these topics, and that's the framework that people that have this tendency towards success and more things, the next goal, and not everybody's like that. It's
like a type.
Right? It's a type of success-driven, success-oriented type, and also high energy. You're very high energy. I'm very high energy, so this energy constantly needs to be channeled somewhere. There are people that are just simply not like that. They don't have that problem. But for us, the framework to build is not how to reach the next goal and achieve the next target. The framework is actually how to be in balance with what you have and really appreciate what you have, because you have so much, right? Okay, you don't have a 100 million company, but you have so many other things like health, public recognition. You're a great speaker, all these fucking things that somebody that's 100 million plus net worth maybe have none of that. There's one person, they fucking sniff coke every Friday they travel around private jets, but they're deeply unsatisfied. They don't have a family, for example. So
makes sense. I actually had Martin, your acquaintance, a good friend. He was also one of the youngest Latvian millionaires, and we talked about energy, and he said after 30 nicks, energy gonna go down, just biologically. Would you agree with that statement? Because I think you're 36, right?
37. Yes and no. Again, I think there's different calibers of people that have different level energy naturally. Some are higher up, some are kind of more toned down. I don't think that if you're super jumpy, high energy by nature, then you're going to be more or less like that all the time. Exactly. But I can tell you, I've spent the last month and a half in a very kind of regimented routine everyday life, meaning I wake up, kids go to school, I train, I go to office, spend long hours in the office, come back home, whatever, eat, family, a little time, and go to bed, right? And like week in, week out, okay? And what I was gonna say, energy. Fuck, what I was gonna say. What was the point that you were asking?
So we were talking about, like
high energy.
Yeah, like people lose energy after 30 because of biology.
Yes, and with this disciplined couple of weeks, like really nonstop work, training, nothing else, not a lot of like let's say outside activities, I feel like I get tired for sure faster, and I need a break definitely much faster than if it was 10 years ago, because I look at how much I worked, how many literal hours I worked when I was like 25 or 27, and it was 8 a.m. to 8 p.m. and it was 6 days in a row, and Sunday I just had to relax, and then Monday you go again, like, and that's not possible. I can't do it anymore. So that in that part I agree with Martin and with this physiological effect.
Would you take some more advanced medical influence? I don't know, like like stem cells.
Yeah.
Are you open to that? Would you want to do that? I'm for sure. I want to do that for sure.
Tell me, because I don't pay attention to that. I think more important is to do what you like. Let's say if you like sports, you do sports. If you like eating well, you do eating well. You need to sleep enough. I think those fundamentals are more important than taking supplements. But maybe you have a different.
Faster. It's like the feeling is I'm just gonna do that, and I can still be like.
But do you do it?
No, not currently. I'm taking some peptides. But that's for recovery.
Yes.
Like this is like not
because you have a lot
like
of energy output. You do a lot of training.
I do a lot of like muscle breaking down.
Yes.
I'm doing that, but I'm very keen on doing my tests a lot. So right now my wife is kind of like promoting this fish oil, which I'm also drinking.
Yes.
I did the test.
Fish oil, yes,
really bad.
Fish oil and vitamin D.
Those two. Because especially for us in Eastern Europe, it's like it's not so sunny.
Yes.
I actually wanted to talk about a little bit more about the debt. So I think when you raise money, you have the debt. The investors are like, they know what the money is going to go to because it's super obvious. But when you raise for equity, is it always like they want to kind of control where you spend that money? Because what happens then? Like what's the
actually so what's important is when you take the equity funding is what strings attached come along with it, which means primarily whether the investor is sitting on your board and what decision-making powers and veto rights does the investor have when they give you the equity money. And if they get on the board, and that's a legal say obligation and influence on the company, can they block approval of the budget? Can they block, let's say, sale of the company, any asset sales? Can they block bigger expenses? Can they block payouts of dividends? Can they block hiring executives, etc.? So if you have a scenario where somebody invests a lot of money and they say, I want to be on the board and have all of these rights, then you will be very much affected by somebody.
And typically they do want to do that. I can imagine, right?
Man, there's so many scenarios. There are companies and investors that want to be very relaxed and very reliant on the founder doing their thing because they believe that the founder got the company there and they're going to get it further. There are companies that are less kind of VC, entrepreneurial, more control. Those would be private equity, kind of financial investors that are kind of more aggressive. They're more black and white. They just focus more on the company rather than the founders and the people. And that applies to a stage where the business is much bigger, where you can cut costs and you can standardize things, lay off people, and so on. So I'd say it's a very nuanced question. It depends on
the situation,
the phase of growth of the company.
If you right now have no connections, no previous businesses, no existing businesses, and you would need to raise 1 million for your idea, what would you do?
I would first of all challenge whether 1 million is really what I need, because if you need 1 million for an idea, you have no existing experience, you're starting off, so it's your first business, that's a lot of money to test for an idea. So I would try to cut it down to something that's more manageable, because 1 million for a person that's coming in is, I think it's an unrealistic amount of money.
Oh, really?
I mean, for me, yes, the way I see it, I think it's if you're 20 years old, and you're not in America, you're in some random fucking small country, and you have an idea to just like figure something out, build something, and $1 million, then it's a lot of money. That feels it would feel very unmanageable. So I would try to kind of chuck it down in small pieces to make it more manageable. That's one. Second, like what we did, we just spoke with all the people that we had in our network. Most of them said they don't have money, they can't help. But then there were a few that I knew, not even like personally very well, but through some of my friends that had money. And it took us, when we did it first, it took us 6 months. 6 months to get the first investment, but the first investment was very small. And then the first investment gave us a bit of results, and that gave us a bit of confidence so that we can go to the next investor and ask for not 30,000 euros, but for 100,000, yes, or 50,000, just slightly bigger every time. But again, that's our experience. I mean, or my experience, which is 15 years old right now.
You would do it the same way, right?
Would I do it the same way now? It's very difficult to tell you how I would do things now if I was in that position that I was 15 years ago, right? I would now say, of course, I will, draw up a super cool presentation. I would probably try to go to the US right away, buy some tickets, and I would try to raise money at crazy valuations, much bigger amounts of money from, big VCs. I would not try to do that from like my Russian friends, But whether I would have that mindset, I don't know. Back then, we just, we were doing what we thought was possible, right? Like 15 years ago, man, I didn't have fucking money to buy a Ryanair ticket to go back to Riga on Christmas from London. What kind of what kind of fundraising in Silicon Valley are you talking about, man? It's completely imperceptible. It was not possible. It was not within the realm of fucking realistic, scenarios. So,
and I know you have been in both scenarios. So you have been raising money, and I know you have been giving money or being the AKA the investor.
Yeah.
What are some of the kind of biggest wins or biggest losses or the lessons you have learned from being an investor?
So first of all, I'd say I don't enjoy being an investor particularly. I don't think I'm a good investor. I think I'm a better entrepreneur, primarily for the reason that if you're an investor, you really have to hold back and be basically passive. I don't really also believe in this super active investing. If you give money to somebody, that somebody will build out the business, right? I wouldn't want to give money and then participate and get involved, because that means that the entrepreneur, the founder, is not good enough, right? I shouldn't kind of work with him. So I'd say, first of all, yes, I don't think I'm a great investor. I don't particularly enjoy it. I don't therefore spend time on, investing as a kind of primary way of spending time. So for me, and that's all I've learned through experience. I didn't understand this about myself when I started doing this, because when I started doing this, the standard perception is you make a little bit of money or make a lot of money, and then you become like this tech investor, right? Like giving angel tickets and so on. I did that, and I just I'm not super excited. I don't care that much. I never made a lot of money as an angel investor. What I have made money successfully on is when I've given loans, different types of situations, B2B loans and so on, where I make 15, 20, sometimes 25% per annum, which is a fantastic return. If you look at the regular VC returns, those are higher than some of your very good VCs. So I've had more experience in giving debt, making fixed interest every month, and knowing that I'm making money on a regular basis, and that's what I not enjoyed more, but I know that that's more sensible for me. So investors, there's a lot of things I could talk about investing. With my experience, I've done, I don't know, over $1 million probably when it comes to kind of equity investing, and we've done much more as debt investors through our investment platform and as private investors.
How was your experience investing in real estate?
Fucking shit.
What happened? How big was the deal, by the way?
So I've done a few things in real estate, but the one that was hands-on was actually with Matīss. We built a very amazing premium property in the not outskirts of Riga, Rīgas Mārups borderline. And we did a lot of, I think, mistakes for various reasons there. But the most important, not mistake, but the circumstances were that the war started, Ukraine war, and COVID started. The builder went bankrupt. We had to manage that situation, and the length of time took much longer to build it out. We thought we are gonna sell the property. We ended up looking for rent, and now it's a mix of selling and renting. But the moment you have delays in real estate, you start losing money, and that's what we had. Even though the product is fantastic, the actual house, the location, the materials is all fantastic. To be honest, I never took that as an active business. It was more passive for me. And I also learned and figured that I'm not naturally, passionately kind of interested in real estate. It's not something I think about, and I have a vision for how these types of things could be done. My strength is more in the, how to say, not digital, but like operating with information and operating with people, not with physical things. I just don't think in those terms. I don't think in terms of how to build a product that's tangible.
Are you passionate about the fintech business right now?
And I'm passionate about fucking enduro riding this.
Right? Because I was thinking, when you say these things, I can imagine, right? It's not so much fun, right? Like, after a certain point, right?
Man, for sure. Of course.
Because I think the thing is, when maybe the financial situation is like that doesn't change your lifestyle or something like that.
There was a very interesting, I think, also some YouTube interview where some relatively young guys, they were interviewing some old billionaire, and he was saying, guys, and I listened to that a long time ago when I was in my 20s, and I listened to that, and the guy was saying, you probably don't see it and understand it now, but you are in the most exciting part of your career right now. Not when you're 50, 60, 70, you got like a fuckload of money and you've done things like 10 times over. That's not the most exciting. The most exciting is when you don't know how it's going to happen. You're like hungry, you're starving, you want to prove, there's so many unknowns, you're doing things for the first time. Like the excitement when we were building out companies, when I would go to the offices and see all these different people and they were all working for me, it was like fucking amazing. It's like an electric feeling. There were like projects, project management calls with a lot of managers that I never knew that we have. And I was like, fuck, it's like growing so fast. And that was a great feeling. And I've never had that feeling ever again, even though later my companies have grown faster. So we've opened a country where I've never visited. We have hundreds of people. I don't know them, but I'm like, I'm more, how to say, just looking to make money there, right? I don't have that passion anymore. To some extent, but I think it's just phases. In another phase in your life, you have to look for this rewards and fulfillment from other things. You can't like be excited and fulfilled about the same thing 30, 40 years in a row, right? It's not logical. It's not natural. So
that's why this year we go to Romania.
Yeah. For example, Romania, or for example, doing the podcasting, the broadcast experience, the ability to package your some sort of a message that you want to pass over, do it at scale. That's a very different, I think, direction. I think it's very valuable because it's valuable for people. I think it's valuable because it builds your own skills. It's a completely new, different direction. So that's to some extent as exciting for me as building another lending business in another country, which I know everything about, right? In this one, there's so many kind of unknowns. So yeah,
cool. I think that's a wrap. It was
cool,
very sharp.
Cool, man.
Very sharp.